We are live now. Thank you for attending today's event, Lender Secrets to Convert More Deals. I'm a Deepak Party and I have Akshay Party from Shining Star Funding. We will both be taking turns in presenting some material for you, and we hope this material is going to be useful to help you understand how you can convert more leads and how certain deals which you think are not possible are possible. So without much delay, we're going to start a small little presentation for you. And whenever there are questions, please feel free to add the comments and I address those as well as we go. Just give me 1 second here. Akshay, can you see my screen?
Yeah.
Okay. So go ahead.
Okay, welcome everyone. I'm Akshay from Shiny Star Funding. As Deepak mentioned, we want to provide you guys with as much information as we can. One, to give you background and overview on who we are and what we do. And second, to let you know what type of deals are possible and what we can do in this space. So can we do the next slide? So we are a branch of Finance of America. Finance of America is a national company, and it has recently been publicly listed under the ticker FOA. What we like to say around here is that we have the tools and weapons of a big company with the service and attention of a small company. Next. So as you all know, lending is not really black and white. In fact, if you go to two different lenders, you may get two different opinions and two different options of what they can do. Um, Generally, depending on the type of loan, we focus on and we look at income calculations, credit evaluations, appraisal evaluations, and we'll go more in depth into that in a second here. But what debt is included, excluded, and we look at various different options of what is the best way to structure the loan for the borrower. Because we are small and we're not trying to churn out these loans, we really do spend a lot of time with the borrower and spend a lot of time on the files and with the realtors and everyone involved in the process. So yeah, we are looking at a lot of different aspects of the file, and there's a lot of flexibility and a lot that we can do. So take advantage of getting another and a broader evaluation from us. One of the things, today's market is very competitive, as you all know. And one of the things that we can do to place you ahead of the competition is we can provide pre-underwritten approvals if you're putting non-contingent loan offers. All we do is we kind of go through the same process as you would. Streamlined version of that. We request all the files, and then we have that underwritten so that you're comfortable removing the loan contingencies from your offers, thus making them more competitive. We are seeing on a lot of refinances and purchases as well, where if we structure the files a certain way, and some of the criteria is listed over here, that we are able to provide appraisal waivers for those borrowers, who do not maybe have the time to schedule an appraisal for their home, or do not want the appraiser in their home, or you know, waiving the appraiser generally does increase or decrease the amount of uh, the time that it takes to get through the loan. So we can close these loans generally a lot quicker. As you can see over here, we can do appraisal waivers on principal residences and second homes up to 80% LTV and CLTV. However, 2 to 4 unit properties, co-ops, and manufactured homes are ineligible, and values of properties that are provided to us that are greater than $1 million are ineligible. So we were talking a little bit more, little bit before about making your offers competitive. So one of the things I'd mentioned earlier, and Deepak's going to go into a little bit more detail in a little bit, is loan contingency, removing that loan contingency. However, there is another thing you can do, which is removing the appraisal contingency. So once we work with our realtors and the borrowers to take a look at where they're purchasing, taking a look at running various different AVMs using subscriptions available to us, looking at MLS data, looking at the growth rate in the for past and the future in the neighborhood, looking at asset reserves and flexibilities for the different programs that we have with the LTV. So, in case something appraises for lower than what was expected, we can kind of adjust using assets and or the LTV.
So I'll jump in from this slide onwards. Making offers for no loan contingency, like Akshay said, these are TBD approvals and they are fully underwritten. They are underwritten for credit. So we'll go with credit, income, and assets. What's left basically out there is the appraisal because the property hasn't been identified and the title. So if when the property is identified and based on the previous slide, if you're doing something where we are looking at AVMs, MLS, and you as realtors can help your clients with the data to show what properties have been listing for, what they've been selling for, what the growth prospects are, and you're making, in other words, you're making a no appraisal contingency offer along with a no loan contingency offer. It's one of the strongest offers for the right borrower. So if the borrower is strong and making a good offer, it is as good as a cash offer and stands a good chance to get accepted by the seller in today's market. These are some of the flexibilities that we use when we're going to underwrite your files. And one common flexibility that I like using for conventional loans is 1 year tax returns. And these primarily apply to all kinds of income, whether it's self employment income. Yes, most realtors would remember or think of self employed borrowers having to average 2 years' income. That is not correct. We can go with just the most recent self employment income. Wage earners. In case of wage earners, we'll use the most current income. In fact, in situations where they have an offer letter standing at times, we'll use the future income. Retirement income, again, if they just started getting SSI or just started retired and started getting pension, we will go with that income. And rental income, again, is averaged only over 1 year. So most times this is useful when you'll see that maybe in today's scenario, maybe 2019 tax returns were not as good as 2020. All we'll do is look at 2020, average the income over 2020, that's 12 months, and give the borrower income for that. And instead of averaging over 24 months, which would drop the income, now the borrower has more income because 2020 was better than 2019. Jumbo loans, we have flexibilities to go up to 50% instead of the 43% QM rule that most of you are aware of. These are not expensive loans. We have a special product called Easy Jumbo. It'll go all the way to 90%. That Easy Jumbo product goes to 45%. And a flexible jumbo that we have goes all the way to 50%. Now, these are really useful in places like a county where for example, San Joaquin County, someone wants to buy a property for 800,000, and the limit in San Joaquin County is, I believe, only 548,000. It would you would either have to do a first and a second mortgage, or the borrower would have to cover the difference between the 800,000 and the 548,000 in terms of down payment, or else this jumbo comes as a savior where you can put 10% down and get a loan of 720,000 in San Joaquin County. The reserve requirements, which you've heard of in jumbos, can sometimes stop people from buying because you need money after the purchase is completed. Some of these jumbo loans do not have the reserve requirements. Income verification is limited. Like I've already shown you, we have the 1 year tax return programs which we can use in these cases. And there are many other guidelines which a QM, a jumbo lender, would have that are not in some of these jumbo guidelines. Dealing with this is a scenario, like a niche, that it's one of the niches that we decided to show you as a slide. It's one of the niches amongst several. We cannot cover everything, but just to show you employment gaps. At times we get calls all the time, the borrower's not been on the job for 2 years in a row. What do you do? Well, there are ways to bridge that employment gap with a letter of explanation, where if the borrower was employed for 2 years in the past, is now not been, or took time off for 3 4 years and just got on the job in the last 6 months, we can overlook that entire gap. Sometimes people do not have 2 years work experience, but guess what? The education experience, if they came out of a master's, or they came out of a bachelor's degree and they have that work experience, we use that to supplement the 2 year work experience. I already mentioned we can use future income for borrowers when we are planning to qualify them. And I just mentioned about the education in lieu of employment. This is coming up very often these days, where there is mortgage forbearance, whether they're buying another property, they have a new existing property, and they decided to use the forbearance eligibility. And we can deal with those loans as well, whether they are jumbo loans or conventional loans, as long as these guidelines are met. Forbearance should have ended. They should be on a payment track record of three payments, and the past arrears which were added back to the loan, which is what the forbearance guideline says, can also be covered through the loan. Again, going back to those jumbo loans, which are the 10% down loans, loans go all the way to 2 million with a 680 FICO score. Conventional loans, you can actually do 822,000 loan with a 5% down in a county which has the limit. So, Contra Costa County, for example, has a limit of 822,000. So you can go to 822,000 plus the 5%. So your purchase price would be a little more than that amount. Jumbo loans, most of the jumbo loans that we have, when they extend to beyond 80%, we have options at 85 and 90%. They'll all be without MI. We, of course, offer the FHA and VA, and we also offer manual underwriting for FHA and VA, those that cannot get accepted by DU. And there are certain other loans. We did a class last week on bank statement and asset based loans primarily. We call it alt lending. And we, instead of using tax returns, we use income calculated through the bank statements, or income calculated based on the assets the borrower has. With that, this basically summarizes our presentation. And let me just
Why don't we take 5 minutes and just discuss quickly the most common questions and queries that we get from people um, to for on some of these programs and stuff.
Of course, of course.
So yeah, so the couple that I jotted down and chime in whenever are so appraisal waivers. I know we talked about that a little bit, but do you want to just go into a little bit more depth about why those are helpful and why, you know, obviously in addition to people saving money, how they can benefit people?
Appraisal waivers. Time is the basic thing. You can benefit by time. You can benefit by the fact, and I've had situations where uh, the realtor was not confident on the value. They were over offering the value of the property, and when we input the values in DU, we actually got a waiver. So technically, the buyer made an offer on a property, offered 100,000 over, and didn't even have to get an appraisal because we got a waiver. It saved him time, saved the question mark about whether they would have to come in with more down payment if it appraised for less. So there were a lot of things. The anxiousness goes away basically. Time is saved, money is saved.
Yeah, and especially the money aspect is very important to people as well. So the other couple things that I can think of are, if there's no W-2 or self-employment income or something, people think they might not be able to qualify. However, as we mentioned earlier, there are different programs that we can look into. We've recorded a whole another video on that with alt programs. So you guys should definitely watch that too. But we can look into bank statement or asset based programs for that. Um, Other things that I can think of are, in this market, people are trying to get into new homes, but at the same time, they also want to sell their homes. So, how that could work if someone cannot afford both homes at the same time, we can certainly look into those options. And then we just talked about the 1 year tax return option. So that one is a big one. If 2020 for you was significantly better than 2019, then there's instances in which we can plug in all the info and be able to just do the loan based on only the 2020 tax return. Anything else that you can think of?
Um, Making the most aggressive offer in today's market when everything is being outbid needs not only a lot of input by the loan officer you work with but also by the realtor. So in other words, if the realtor can support the offer based on the numbers that are coming from the MLS, the projections that are coming from the AVM reports, because AVM reports these days are smart enough to predict how much the value is going to go up by in the next 1 year. And if those numbers, AVMs, are available everywhere, the realtors can provide AVMs, we can provide AVMs, and those AVMs can help you determine what the right offer is. Now, when you're making that offer, and as long as a borrower has assets or a borrower has the flexibility to go up, because you could already be maybe just hypothetically you're putting 25% down, and the property does not appraise or appraises a little less. So we can automatically adjust your LTV within the program guidelines to increase that and get you what you want without having to adjust anything else. So you would just end up getting a slightly lower absolute loan amount because the appraised value came in less, but it would still fit into our program guidelines. So those things are big. Using flexibilities in the programs are big. The bottom line is pre- preparedness upfront is important before offers are made. So prepare yourself knowing what you exactly want. And like Akshay, you mentioned about people who are upgrading or downgrading, either way, they need to know how to handle the existing mortgage before they get into the new mortgage. Are they going to be selling before they buy? Are they going to be selling simultaneously? Those are the complex questions which a realtor and a borrower face. And if you make offers contingent on the sale of your house, no seller is going to accept those. So those needs to be handled before before you actually go out in the market looking for homes.
Yep, I think those are the only ones that I can currently think of. But anything else?
For based on the agenda, limited agenda we have today, yes, just that there are so many other niche areas we can go to. But the overall broad agenda today was how to be competitive in today's market, how to be able to succeed, convert more, succeed, and get the client into the property that they want.
Yep, yeah, that's right. And give us a call, or email us, or reach out to us in the group if you have any questions, or if you just want to brainstorm scenarios or anything. And we're here to help.
Sure.
Thank you, everyone.
Thank you.